So what I want to do tonight is a quick review of paper 7. So there's 3 parts to it. So just to remind you, I think we've done this before. So there's pressure on your mind. This is the relative value paper. So you have 3 things to do. 2 of them involve Excel. Well, all 3 of them involve Excel. One of them involves the Excel you did for paper 4. But the first one is just your historic relative. So I've given you this file. I did this, Javier did this for XL. Nothing was working, everything was breaking down. We still got it all done in 30 minutes. So it's not a huge time. Maybe, well, it took an hour, but the time we weren't switching PCs, it took about 30 minutes. So all we did here is you load this file in Bloomberg. You can't do it on this machine, but you do it in Bloomberg. You change your ticker here. You notice what I did here. Why did I change this? Before it's consumer staples, Excel is the utility. So I went and got the sector ticker for utilities and put that in there. It updates all the data. So here's all of his data. We changed the date to 12/31/1990 because that's when he started having data. So you go down and see, where does your data start? So the one you load, I forget what it comes up with Walmart, but it loads a few years before that. But his data didn't start until 1990, so we just started in 1990. We copy and paste the values here. So you have everything you need there. The instructions are actually in there. And then you have the output. So for Excel, historically, they've traded right in line with their industry. Right now, they're about 9% rich to that. They've traded about 19% cheap to the S&P 500. Right now, they're only 13% cheap. This is the PE ratio. So what would you suggest is the most likely ratio you use for utilities? PE, EV to EBITDA, EV to sales, or price to book? What's the most logical one? Well, price to book for utilities. So if property, plant, equipment is a massive part of your balance sheet, price to book makes the most sense. Now, as far as EV to EBITDA, the question is, let's do the relatives on PE ratio. Unfortunately, it goes much further down. Yeah, this is one thing I don't like with this file is, if I were you, I would find where the data ends and I would get rid of all these formulas because there's formulas there. Just get rid of them so you can do your graphs. But if we look at, this is where they're trading versus their industry. This is who trading for this S&P. You can see they're somewhat in line with their long-term history. You might do one of these charts at a time. So maybe you'll do them. They're right in line with the industry. It looks like it's, well, not quite one, but it's right in line with the industry. So you can certainly add charts to just show that they're slightly rich, but not materially so. They're essentially in line. Make sure you put your dates down here. So you can change these charts up, but you have what you need to build a depth analysis. Price to book makes most sense, but let's say some of you are going to see something where you occasionally have this in your chart. It just messes it up. So what do? If you see, why would that happen? Well, because their earnings went almost to zero. And so their price to earnings is like 20,000, something like that. But does it make sense to show a chart like that? So what would you do? I would just go in and find those numbers. I don't know if we can find them. I would just go find those crazy numbers. I would just take them right out of there. Zap them. so that you don't have that massive thing. So you occasionally see this with firms. So there's one option is you say, you know what, let's just take those huge years out. The other option is PE ratios are far more sensitive than EV to EBITDA ratios. So maybe go to EV to EBITDA. So if your PE is not working, then go to EV to EBITDA and see if that gives you a better looking chart. Price to book, they've historically traded about 2% cheap. Right now they're trading about 4% rich. But historically, they're trading cheap to their relative to the S&P, and that's probably because of the heavy tech influence. But it looks like a fairly consistent number, right, for them, rotating around one. So they were real expensive not too long ago, but now they're right back in line with their historical numbers. So, so that's the kind of things, Javier. You just put these charts in there and you just say, where are they today? Where have they been historically? You got the data right here. You just say, well, y'all remember how to say this, right? XL is currently trading 4% rich to its industry price to book basis versus trading 2% cheap historically. Currently trading 6% rich history with all kinds of typos. All right, pretty simple stuff. This is like the easiest part of the paper because I've done all the work for you. I already built the chart. Now let's say you can't get up here to get the Bloomberg. You've got 2 days, tomorrow and Thursday. Email me and I'll do this for you. I essentially did that for Javier, right? Javier just built it because we couldn't get Bloomberg to work. So I just did it and emailed him the file. So if you can't get up here, I'll do it. It takes me less than 2 minutes to do this. So if someone says, I couldn't do this because I can never get up here, well, then email me, I'll do it for you. You have no excuse on that, all right? So pick the ones that make the most sense. Some students do all of them. Price to earnings, EV to sales, EV to EBITDA, price to book. That seems a little overkill to me, but try to find the ones that make the most sense. Price to earnings really should be in all of them, but if you have really bad data for price to earnings, that's when you can substitute EV to EBITDA. Tech stocks always use EV to EBITDA. What the retail stocks use? Remember retail stocks? We talked about that whole class on that. EV to sales, right? Anything we're focused on margins. So, so you've got all the data you need in the spreadsheet, and I'll definitely do the spreadsheet for you if you need to. I even put the sector tickers in there if you want to do it yourself. It doesn't take that long to do. We were having Bloomberg problems with Javier, and it was bring up the file and giving us all kinds of error messages. So we had to switch machines like 4 or 5 times to get it to actually work. So I'm not real sure what's going on with our Bloomberg accounts. But if you need the data, I'll get the data for you. The second thing is I was hoping Hector would be here, but I don't see Hector here. Maybe he's on the Zoom. But so Javier and I also built this one. It took like 20 minutes, right? Because I had a conference call coming up. And he actually got a really good model. He's got a 72% R squared. So here's the factors he brought in. He brought in factors related to turnover, so sales growth, asset turnover, and working capital to sales. He brought in 3 margin numbers: gross margin, EBITDA margin, operating margin. He brought in 3 things on return on capital, return on cap, return on equity, and EVA spread. Brought 1 number in on risk. He brought in price to book because he's doing their utility. The model did a really good job for him because it gave him some stuff in every category. It gave him 23% in turnover, only 3% in margin, but that somewhat makes sense because this is a very regulated industry. Your prices are set. So you are, I guess, 5% in margin, 51% in return on equity. That somewhat makes sense. This is an industry that is somewhat capital intensive. And then 21% on risk. So he's got a pretty good spread throughout all of these. So you can build your own model if you come up here and I help you build one. So Hector and I did one last night. It took about 25 minutes. Javier and I did one about 20 minutes. And you can get the 10% bonus if you just come by and let me build it with you. And I'll probably do all the work just to speed it up because we're running out of time. I was going to mention Hector. So Hector and I, we built one for industrial. So if you got an industrial, we've already got a model that works. So you can email me and we can send you that model. We can find it. I think it's on Hector's computer, not one I have access to. So hopefully he can email that back to me. So we got consumer one built, we got a utility one built, but I think Javier, you're the only utility, and we got an industrial one built. Fernando has a really good technology model. Will has a really good semiconductor model. You just did semiconductors, right?
Yeah.
So you got a good semiconductor. So if you need another model, you better tell me. If you're not going to come up and build it yourself, you better tell me real soon, because you don't know when I'm going to be on campus again. And it takes, 30 minutes to build a model. If you want me to build a model for me, you don't want the 10% credit, extra credit, then you better tell me you need me to build your model and I'll build it and send it to you. Or come up here and we'll build it together, one or the other. But it doesn't take that much time, especially with me driving. Since we're so late in the semester, I'll probably will drive, just because we got to move fast. But I'll still give you credit. You sit there and shake your head, yes, like you know what I'm doing. I'll still give you credit for building the model. So here's his model. You can just tell looking at it, it's a fairly decent model. Here's his company. His company's a little rich, but not materially so. So we've got a pretty decent looking model here. He can clean this up and make it look nicer, but it's essentially, he has what he needs. He could highlight a few other companies. There's just some obvious competitors in there, but his firm, Excel, he thinks it's the 18th best company, but it's the 15th most expensive. So it's slightly expensive, but not radically that expensive. So he's got a good model. Now he has the advantage he's doing utilities, which tends to be kind of like semiconductors, tends to be a little bit more of a cohesive group of firms, probably even more so than utilities, than semiconductors. All right, so that's the second thing. All you do is you build a model, you talk about watt factors. I don't even mind, you do something like this. You can just put something like this into your paper. See the model allocated 22% to that. Turnover allocated 5% to margin allocated. You'll see this in some of the example papers. 51%. And then 21%. And hopefully when you add them all up, it adds up to 100%. That wouldn't be bad to add. You could talk about that it really liked return on equity, which to me is interesting. Why does the model like return on equity more than return on cap? And is there a way we could test how important that is? Anybody have an idea? How could I test if it's really that important? Any guesses? What's something we do in 3 seconds to see? Change the white. What if I do this? Was it material? What did my R squared do? It's 55% now, 72%. It really does like return on equity better. All right. I can't give you an explanation for that, but that is why. You have to have that one. It is possible when you're doing solver, it's possible you put the 51% return on equity and the R squared goes from 72 to 71.5. In that case, you say it's indifferent between the two. Same thing over here with operating versus EBITDA. Does that make a difference? It doesn't really make a difference. It was somewhat indifferent between those two, which kind of makes sense. So you can test a little bit. You can change some of these a little bit. I really like WAC EVA, so I'm going to put 10% there. I'm going to take it out of here. That hurt it a little bit, but at least I got a factor that I think is important. Can you see it in the chart? Not huge, but there's definitely moving further away from the line. So there's some quick things you can do in these models just to see how material it is. Now this is a pretty simple model. What I think, Juan, I think your model, you do multiple years kind of things. You can look what's the average over time. One thing I don't think we did in your model, which has worked really well in the past, is to bring in a net margin and just calculate the standard deviation of the net margin as a risk factor. And just see how volatile that. Do you think the market prefers firms with stable margins over firms with volatile margins? You could test that. Bring in 5 years, calculate the standard deviation, and see if, as a risk factor, that goes into the model. So there's a lot of things you can do here, but this is a fairly simple model. We didn't need any fancy formulas to do this model. So, all right, so that's the second thing you do. You talk about the model, what you had, you have the chart. You also have some example papers, student papers that do exactly this. You can see what they talk about. It's pretty easy to find. You just find the chart, it looks just like that, and see what they say around it. It's not massive amounts of discussions that you have to do. It's not that difficult of a paper. And then the last thing you do is in your forecast model. I built it somewhere. I can't remember where I put it though. So we've got it somewhere in here. There it is. So you built your forecast for paper 4. And then you're going to, at the very, very end, wherever we put it. Here it is. So you come up with what you think the ultimate PE ratio is going to be. You put your dividends, your earnings per share, get the present value of that. And it's there, very, very straightforward. So use your forecast. Some of you, I forget which forecast I was working on with somebody the other day, but we went out, it might have been Amazon. So we went out, that might have been Alex. So we went out an extra 5, 10, 15, 20 years until the growth rate got to be normal. And so you may have to go out more years to do that. But this is the standard investment bank approach, with the exception that we're using the KE, the discount, versus the WAC. So the standard is value the firm using the WAC, using free cash flow instead of dividends. So it's a little bit different model, but that's the traditional model. Is you have free cash flow per share of the firm, you have earnings per share of the firm, you take the present value of that, you get the future price of the stock, but by applying the earnings per share times some PE factor. You take the present value of that by using the cost of capital of the firm. You then subtract out the value of the debt, you got the value of the firm. That's the traditional approach in investment banking. We're not doing that here. Why? Because I didn't want to saddle you with having to come up with the WAC. It's a lot of extra work. But you can do the same thing. Instead of using cash flow to the firm, use the cash flow to the stockholders. Everything else works the same. You just use the cost of equity capital instead of the cost of WAC, instead of the WAC. So that gives you evaluation. I'll try to remember to save this out to Blackboard. So those are the 3 things that you do in this last one. So in the so the 3 things you put in this paper. And once you finish that, you've got it, you're done. You do have to justify final target ratio. I'll show you how to do that. So that's it. That's paper 7. It's got just about everything in it. that you would need if you're going to be interviewing between papers 5, 6, and 7. It's the basics of what we're doing. All right, so this model I can run for you, or you can come up here and get it yourself. This model I can build for you. You can build yourself, or you can come up here and we'll build it together. And I'll save this out to Blackboard if I remember. So you have it. All right. Questions on paper 7. All right. I can't tell if y'all don't have questions or you just have no clue what I'm talking about, so you don't know what to ask. It's an interesting thing with this class. There's nothing we do in this class that you haven't already done in all your other classes. But for some students, taking 4 years of college and putting it together is like it's just too much. So it's essentially a capstone class. The problem with that, if you're really overwhelmed, is that when you get into the job, they expect you to know all this stuff. This is kind of the stuff that they just expect you to know. A lot of students don't. If they're from Harvard or Stanford, they don't know any of this stuff, but they do just expect you to sit down and do a financial analysis of the company, do a discounted cash flow of the company, know what to do with relative values. The technical analysis, yeah, you could probably kick that part out, but I threw that in because it's the easiest paper and it gives you a chance to offset a lower score. But yeah, I mean, this class just pulls everything together that you've learned over 4 years. Hopefully it's feeling comfortable for you. If you get a first job as a security analyst and they don't give you any training and all you did was this class, you'd be in good shape. You really would be. You probably far surpass anybody you're competing against in the job as well. All right. So last class we talked portfolio management. I can't remember if I saved my files for that, but what I want to do is show you some examples. How do I get rid of that thing? Won't let me. Okay. All right. So portfolio management. So if you're going to interview for jobs on the asset strategy side or on the security analyst side, you need to develop some type of philosophy. So remember, philosophy, process, construction, and risk management. So I'm going to show you some examples of firms. I wish I could get this so it's not. I don't need this over here, but it won't let me.
No, you can click the little through, you get that.
All right. Everybody's got their own little software. So this is a firm. I didn't really care much for this firm, Mar Vista. I don't know if they're still in business or not. There's essentially 2 guys that went to school together. You know, your networking in college is extremely important. 2 guys went to school together, and 10 years later, they say, "Hey, let's start our own firm." And that's what they did. And they now have a few $1 billion at the time they showed us this, a few $1 billion. We didn't hire them because I wasn't particularly impressed. But here's what they said. Here's their philosophy. Grow shareholder value. That sounds good. That's what we want. I was listening to a podcast today. There's a really good one. This last one of AutoZone was really quite good. But the reason he really liked AutoZone is their focus on the shareholder and that understanding of the shareholder. But he didn't say that as kind of a truism. He said it specifically. Here's what the management does that specifically puts the stockholder first. Wide moats. Well, yeah, we all want that, right? Notice they don't define what a wide moat business is. What do I mean by wide moat versus narrow moat? If you're going to attack a castle, would you rather have a moat? I mean, if someone's attacking you, would you rather have a moat that's 2 feet across or 80 yards across? There are alligators and how deep it is and all that. So how much protection do you have from people coming into your business? How do you measure that? So we got 2 things there that are really hard to measure, aren't they? How do you measure that they put shareholders first? That EVA spread might be part of that. How do you measure a wide moat? Remember we talked about an article earlier. They have unusually high return on equities. They have unusually wide net margins. So how do they define that? Management team that optimizes return on capital. That's essentially the same thing there. How do you optimize return on capital? Again, that EVA spread might be how they do that. Stock mispriced, right? That all sounds really good. Faster than expected growth in shareholder value. Another word for that is what? Stock price is going up fast. Large margin of safety. What do they mean there? Margin of safety means their valuations are far below current valuations. Margin of safety means you think the stock's a lot cheaper than what it's currently, a lot more, worth a lot more than what it's currently trading for. So margin of safety is you think it's worth 100, it's trading for 60. That gives you a margin of safety. Better potential to protect and grow our clients' capital over time. So they're looking for stocks that are meeting these criteria: acceleration or reacceleration. Seeks to invest where relative price risk is lowest and potential returns are highest. Who doesn't want to do that? I want stocks that are going to go really, really fast, make a whole lot of money, but they're really cheap. That's what I want to buy. Anybody here want stocks that are really duds? They're not growing very fast, but those stocks are really expensive right now. Try that in an interview. I'm looking for stocks really expensive, but they're not very good companies. If I can do that, I think I'll beat the market. So here's their process. So we said philosophy first, then your plot process, research candidates, investment candidates, valuation, require significant margin of safety. So they're a margin of safety. Who came up with the margin of safety? Y'all know that? We always say Warren Buffett, right? Wasn't Benjamin Graham the margin of safety person? Have y'all read that book? Safety have an E in it.
Yes.
So Seth Tharman, yeah, when do you also buy this from me for the holidays? See what it's going for right now.
2000, so that's pretty good.
Yeah, it's come down a little bit. No, I want the hardcover. Not worry, if you're gonna spend $2,000, you might as well get the hardcover. It's a good book. Klarman, it's pretty well. It's more of a hedge fund type of approach, but he's talking about margin of safety is how can you make sure that if you're wrong, you don't lose much, and if you're right, you make a fortune. And so that's his idea. He did not come up with the term margin of safety though, but he's the one who certainly has gotten a reputation. Now he did something not too long ago where he got himself in a lot of trouble. I forget what it was. He made some trade that really cost him. But there you have Warren Buffett is under there. That makes sense. Something talking about margin of safety. But I do think Benjamin Graham was the first one who came up with that concept of margin of safety. You're trying to make sure if you're wrong, you don't get crushed. But that's what they say is really important to them. So moats is important to them. Margin of safety is important to them. I don't say that's bad. I think that makes a lot of sense. It all comes down to how you actually measure it. And then there are very concentrated portfolios. So portfolio construction, they only want 15, as few as 15 stocks. And so, and their focus strategy, 15 to 20 stocks. That doesn't, now it's kind of interesting. You got margin of safety, but you're only going to hold 15 stocks. So I guess what they're saying is, hey, we buy a stock, we better be sure this is a really great stock. They do have as many as 50 in some of their other strategies. How do they weight? By growth. So they say firms they think are grow faster are going to get more weight, how cheap they are, and how protected we think they are. The moat side, my guess is they probably have their own internal rating they do on that. I got the sense talking to them that this is all seat of the pants, subjective kind of stuff, that they don't have a lot of computers working here. And then their last thing is what? Sales discipline, right? Your risk management. Stock reaches the price target. I never like that. Why doesn't that, why do you think that doesn't work? If you're interviewing something.
What's the target?
Yeah, the target's going to do what? So you bought it and you're going to, the target's 82 and you really still like it. What do you do? So when we revise our target, it's now 87. So price targets, that's what you determine. That can change any second you wanted to. So that's not good. More attractive opportunities ever elsewhere. Well, that's kind of always the case. Change in our assessment. They somehow it doesn't meet that criteria. Very wishy-washy. This is the firm that said their discount rate for every stock was 10%. That's when I stopped listening to it. So you're going to discount Walmart at the same level, at the same discount rate you discount Tesla. That doesn't make sense to me. If I'm going to buy Walmart, I'm okay with a 5-6% return. You can give me Tesla, I better make an 18% return. It's priced to take over the world. It's priced to grow really fast. I need a high return because this firm could really, I mean, you talk about a margin of safety. There's not much margin of safety in Tesla at all. All right, this is Turner. This is a very quantitative firm. You can just tell he used my term, right? I didn't steal that from him, but I don't think he stole it from me either. Proprietary quantitative model, 72 factors. That sounds really impressive. How do you get 72 factors? It's really easy. You just keep stuffing stuff into your model. It's really not that difficult. We rank all companies in the universe relative to one another based on the predictive characteristics by sector. We construct a diversified portfolio of the best ranked companies utilizing proprietary portfolio optimization diversification tools. I used to be impressed by these terms. And then in 2009, when I retired, I went around and visited all our firms, and I visited, I forget the name of the firm. It was an international firm, very quantitative. And I go in and visit, and I want to see this model. I'm expecting, you know, IBM, one floor, the entire building, massive machines, and it's some guy named Tom is on his desk. It's an Excel spreadsheet. So, wait, this is it? Yeah, this is Tom. He runs as far as once a month. I was like, what do the rest of you people do? Why don't we just hire Tom and the rest of you can go vacation? But yeah, it made me really, really nervous. But that's what this could be. This could be somebody's, you assume these are Python programmers, a lot of AI, all that kind of stuff. But sometimes it's just some guy named Tom with a Excel spreadsheet. Rebalance the portfolio regularly using program trades that minimize implementation shortfall at a minimum cost. That's a lot of gobbledygook. No company is excluded from our research. Well, they're only looking at 3,600 companies, so they're excluding a lot of companies. We have no biases. Do you believe that? What are their 72 factors? That they're biases, right? Of course they have biases. We are not emotionally attached to companies or dislike companies. Now there are some firms, and you could, you know, if you want to work this in, you have to think either one. I want to talk to the CEO face to face kind of person. Some firms like this, we never want to talk to management because we might like them. They might be really friendly people. We don't want any kind of attachment to these people whatsoever. I remember at USAA, the lady who ran our rating agencies, boy, she got those rating agencies so attached to her. They were like, I probably shouldn't say this on film, but well, I'm not there anymore. I don't care. But she was like their best friend. She had them thinking, wow, if we downgrade USAA, we're really going to upset this poor lady. And she was so nice to us. Boy, she knew what she was doing. I'm not going to say, you know, that was, well, it was intentional. I mean, she was a very friendly person, but boy, it's like, so, but some firms say never talk to management because it's going to give us that bias. I don't agree with that. I want to hear management, hear their strategy, try not to get too much enamored by them. We minimize trading costs. That's always good. Re-optimize the portfolio. What does that mean? It didn't work last quarter, so we're going to jury-rig it. So that's what JP Morgan did for us. They had this quantitative model, and they said, you know, it didn't work last quarter, but we've made all these fixes. It's like, well, why did you make all the fixes? Because you fix everything that's going to not work the next quarter. Do you believe in your model or not believe in your model? Don't tweak it just because you had a really bad quarter. So that made me really, really nervous. Emphasis on risk controls. What are the risk controls? That's an easy one, isn't it? We want firms whose PE ratio is below average. How much work does that take? You could do that in Bloomberg, couldn't you? With their equity search, just give me firms whose PE ratio is below the average. At below average EV to EBITDA, that's easy. Lower price to book, low debt. That's pretty easy to do. They want to be neutral to the benchmark on the sectors. Why is that? So this is another thing you've got to decide. I actually think I have an opinion about which sectors I want to be in and which ones I don't. There are some firms that say, no, if technology is 30% of the benchmark, we're going to be 30% in tech. Does that make sense to you? Or if you think tech's going to do great, you're going to be 40% tech. So their thought is, we don't know which sectors are going to do well, but we're good at picking stocks within sectors. So they don't want unwanted sector bets. So what do they want? They want stock bets. Why are stock bets better than sector bets? I can't answer that question, but you hear it all the time. We don't make sector bets. And they say that, not to apologize, they say that as if that's something to brag about. And I'm like, well, why don't you make sector bets? You don't think that sector is going to do well, why are you in that sector? Smaller position sizes, why? Exact opposite of that first firm, right? They don't have more than 1%. They got 100 stocks in their portfolio. Larger position sizes, the largest they'll go is 1.5%. So what don't they believe in? They don't believe in momentum. Because you can't do this and believe in momentum. The beta portfolio is typically lower than 1. Okay, that's probably good. Historically, lower beta stocks have outperformed higher beta stocks until here recently. All right, is there anything there you can still? How do you get the 72 factors? So since you just go on Bloomberg, you just keep dumping factors in until you run out of factors. I forget our champion portfolio model. I can't remember how many factories he had. It was well over 100. He just dumped everything in he could possibly dump in. And he was doing banks. When you do banks, I mean, there's just thousands of them, and you can just dump them all in. Most of them were redundant, so Solver didn't know what to do with them. It was essentially having the same factor 20 times. You do tier 1 capital, tier 2 capital, tier 3 capital, kind of the same thing over and over again. But it's not hard to get up to 72 factors. I mean, think about what we're saying here. You bring in 5 years of data, you do the standard deviation, you do the median, it's all these different things. You can do that with earnings per share. You can do that with revenue. You can do that with, all kinds of things. So it's not that hard to get to that many factors. All right, here's one. I don't know what company this is because all they have is their logo. Small cap growth. Here's their definition of market cap. This is pretty old. You'd have to go larger than that. 40 to 60 holdings. Top 10 holdings are pretty concentrated. They say they're bottom-up stock selection. What does that mean? They don't have a computer model. They're not looking at macro events. Sector exposure, variable. Portfolio objectives, excess returns. They want to beat the Russell 2000 by 200 basis points. Where they get that from? Who knows? They just made it up. Tracking error 5 to 7%. So what is their information ratio? Anybody know that? 200 basis points alpha and 5% tracking error. Somebody else took my risk class, right? Information ratio is what? Your alpha divided by your tracking error. So they're shooting for about a 0.4, 0.5 information ratio. Not spectacular, but acceptable. So they want companies with good revenue growth. 40% of portfolio, they have expanding margins. So that's the other thing we can do. You can do expanding margins. You compare today's margins to 3 years ago. You want firms whose margins are getting expanding. Earnings growth, 20%. What do you mean by earnings growth? Is that EBITDA or is that earnings per share? Now listen to AutoZone. AutoZone's earnings per share growth is probably 25%, and the earnings growth is probably 8%. How in the world do you get earnings per share growth at 25% and earnings growth at 8%? Anybody know how you do that? Buy back shares. Yeah, they've gone from like 150 million shares to like 40 million shares. So are they talking about earnings per share growth or earnings growth? And which would you do? Cash flow. Using cash, generating cash, generating cash. So why do they want using cash? Because these are firms that are growing so fast, they're just eating up their cash. Balance sheet. Unlevered, some leverage. They don't want firms that are growing fast, overusing debt because it's a hindrance. Valuation. I don't know what they mean here, so no telling what they mean there. So I listened to that. I'm gonna share the AutoZone podcast with my EMBA class because they don't believe me that negative net working capital is a good thing. The last paper I graded, they had positive net working capital, and he was talking about how wonderful that was and how good of a job they were doing. The AutoZone guy, he comes right out and say, hey, they have negative. So essentially what he said is really, really interesting. So let's see if y'all remember anything from paper 3. He said, this is a low turnover, high margin business. This is not Walmart. Low turnover, high margin business. Why is it low turnover? Well, if you go to AutoZone and you need wipers for a 62 Chevy, what are they going to have? They'll probably have it, right? I don't use AutoZone. Probably wipers is the only thing I've ever bought from AutoZone. But they want to be in stock. And they're really proud of being in stock, which means they're gonna have parts they're not gonna sell for an entire year. Their turnover is once a year. That's horrific, isn't it? Now, if you think low turnover with high margin business, you would assume the working capital is what? A source or a use? That's what you'd assume, right? Working capital would be a use. Why? Because they have all this inventory. But their working capital is a source. And this guy made a big deal about this. This is a slow turnover business, and yet their working capital is negative. It even said that working capital is negative. And accountants listening to that and go, oh man, this firm's really illiquid. When he says net working capital is negative, what was he saying? He even said, this is a very liquid firm. So it's exact. Any of y'all challenged your accounting professor yet? Dr. Sanders hasn't called me for a public debate, so you're not greasing that wheel at all. But he's saying negative working capital, and that means they are liquid. Why is that? Because AutoZone pays their vendors very, very slowly. They do it in such a reliable way that their vendors can do what? So you're saying, wow, why would I be a vendor for this firm? So you're a vendor, you sell to someone, they pay you really slowly, and you're okay with it. Why would you be okay with it? What is that vendor going to do? They're going to do what with the receivable? You have heard of factoring receivables? So you got this very reliable vendor, you're selling to them. They don't pay you really fast, but you got receivables from them. You can go to the bank, cash in those receivables immediately because AutoZone is very reliable. So that sounds like a really good model, doesn't it? You would think, wow, that really gives them a disadvantage to Walmart. But if they can make their working capital negative, they've essentially got Walmart's advantage, but with the high margins. I haven't gone out and bought AutoZone because what would you say is the biggest risk for AutoZone? Any guesses? There's two things that they mentioned. No, COVID's really, really good for them. When people are stuck at home, they like working on their cars. You know, used car prices are up a bunch, right? So their business is 7, 8, 9-year-old cars. But what kind of cars do they fix? How many EVs do you think they're fixing right now? So EVs is a huge, huge risk for them. The second risk is online. So now they said their business model is, this is a service model. Again, I don't know anything about cars, but their salespeople, supposedly you go there, they'll go out, open the hood and see if you got the right part and they'll fix it in there for you. Is that true for them? Anybody use them? Yeah. So I don't know if that's their case. Why can't Walmart compete with this? Because Walmart can't have wipers for 50 different cars and have them move once a year. That just doesn't work, but this firm can get away with it. So you see things in there that you really like about a business. And if you do, how do you get that into your model so you find these type of companies? All right, so there's one where it has slow turnover, that's bad, but their net working capital is still a source of cash. That sounds pretty impressive. And they do have a moat, that's their moat. Their moat is their service. You go to Walmart to buy blades for your car and you say, can you help me put these on? And what does the Walmart person say? I don't even know what those are. Is that for your computer? I don't really know. Yeah, I remember buying a PC from Walmart. It was a complete joke. The person was, you better know what you're doing because they're not going to help you at all. So how do you bring this into what you believe about stocks? So they say cash flow is using cash and they just assume it, but when you like to have an emerging growth company that's actually producing cash, that's kind of a licensing kind of business kind of model where you have a lot of unearned revenue, right? So why are they giving in on that? Now here's the bottom, people, process, perspective. That's nice and alliterative. This looks familiar, doesn't it? Upside market capture, downside market capture. So they're doing kind of the margin of safety thing. All right, the next one, multi-factor model. Why would you do that? So those of you that built the model for for paper 7, you can now say this in an interview. I built my own multi-factor proprietary quantitative model. Sounds really impressive, especially with human resources people. 48 factors. If any of y'all, how many factors do you have in yours, William? The count, are you getting close to 48? You're over 10.
I think I have 13.
Javier had exactly 10, right? So, 48 sounds impressive. Let's look at what they look at. Valuation, market share is probably what they mean there. Growth, profitability, capital structure, how much debt and equity you use, and then subjective. Non-traditional factors, sales per employee, is that all that non-traditional? Gross profit per employee, that's kind of interesting, right? That's one you could try with Facebook, which would be really amazing. Facebook, I got to guess Facebook has the highest gross profit per employee in the whole globe. Well, let's see, maybe there's someone else out there. Some got one person employee in one first person firm that's there, but Facebook has got to have that. SG&A per employee, R&D per employee. I don't know, why would you do R&D per employee? That's kind of bizarre, isn't it? What is that telling you? So that's a strange one. Did you do any R&D in your model? Yeah, semiconductor models often like R&D to sales, or those kind of things can be really, really helpful. Portfolio managers' collective opinion of management. You can do that and make it quantitative by simply giving management a score, but you'd want to have some kind of criteria, the kind of things you're listening for. They know the business, they've been in the business for a long time, they're focused on the shareholder, those kind of things that you would put in there. Updated monthly. Again, these firms update monthly. What do they do the other 29 days of the month? But a lot of them do this. They update monthly and they trade monthly. So everything's once a month. The rest of the month, they're out there selling. They have high improving score, low failing scores, idea generation, portfolio management. So here's their 48 models or whatever. Or no, these are companies, right? So you'll often see these type of things in more quantitative, especially hedge funds type of processes. Is it any good when it comes out in the numbers? The only problem is, guess who's visiting you? The ones whose models have been working recently, the ones whose models haven't been working recently. You're just seeing the ones that have been working recently, which by random chance, you expect a bunch of those. So here's another one. Was the same firm. We synthesize model output with traditional fundamental analysis, management, contact, evaluation, industry competitive. What is that? Reporters, right? Earnings models, review external research. That's always good to do. They do technical and trend analysis. Here's Penza. I don't know how to pronounce them. So if you're going to start your own firm, make it really obvious how to pronounce. In fact, I'm hoping about 6 UTSA alums come back and we start Roadrunner or Capital Management. I think that'd be a really cool firm to start. Low price on normal earnings, that's fine. Current earnings below historical norms. What are they looking for? They're looking for firms that are currently doing badly and are going to turn around. Management has a plan to recover. The company's business is sound. Significant downside protection. That's not a bad strategy. I could certainly I want firms that the market doesn't like right now for good reasons, but I can see hope for them to fix it. Yeah, that's not a bad strategy. I don't know what you call it. It's not GARP. I'm kind of a QARP person, quality at a reasonable price. But turnaround situations, you can certainly do that as your process. Ranking models is pretty common, similar to what we're doing here. Here's their actual process. I love this. This is really interesting. So I wish we'd done this at USAA. But you get to the very end where you're going to make your decision, and they assign one analyst randomly that has to make the bull case, and they assign another analyst that has to make the bear case. Now, have y'all noticed, have you ever done this before? What happens when you do this? What does this person think after he's been signed to do that? He is bullish. What does she think after she's been assigned to be the bear? She actually hates the company, right? Isn't that amazing? Why? Because she put all her time into it. This is a horrible company, blah, blah, blah. Even though they were assigned randomly, you become wedded. I've noticed that the CFA Research Challenge, the teams overwhelmingly or strongly recommending a buy on their stock. They just become so enamored with their company because they've been working on it. That's not your goal. Your goal is not to make the case for the stock. Your goal is to make the case whether to buy or sell it. But most, probably 80–90% of them say buy. So that's an interesting approach. The CFA research team maybe also try that. At the very end, say, okay, you got to be our bear case. Acadian, they start with 25,000 stocks. So obviously this is a universal, global firm. This is a very quantitative one. Again, you can even tell with all this kind of stuff they have. I like this kind of stuff mainly because it gives me ideas. So there's something I'm missing in looking at stocks. So it gives me some good ideas. Operating quality, price to earnings, momentum. So they have technicals. And so they give them a score on each one of these. Overall assessment of Unilever. So they have an industry perspective. So very, very, very quantitative. And they come up with these rankings at the end. Growth recommendations, macro, industry, all these kind of things they look at. And that finally gives them a score overall. So build something that you can actually present in an interview. Find some way to write it down, what your philosophy is. Still somebody's, if you want to, have something to start with. Let's read the risk management. Quantify and monitor market risk, value at risk, margin equity, stop loss. I don't know what any of that means. Minimize liquidity and credit risk by trading highly liquid securities. That certainly changes the nature of their business. There's been a lot of research done on illiquid securities and that you can actually add a lot of value by trading illiquid securities. So if you're a small investor, that's actually a huge advantage. But a large investor can't do that. Ensure transparency to investors via comprehensive and timely reporting. I don't see anything in there that really gives me confidence in their risk management. This is a currency trader. So what are they looking at? Interest rates, liquidity, spreads, swap spreads, volatility of the currencies, correlation between short-term rates and currency returns, predict returns and volatilities in liquid markets. Bayesian, boy, I love Bayesian stuff. That can be really helpful. Volatilities, forecasted returns are compared to actual returns at each time step to determine forecast error. Guards process, I haven't had statistics in a long enough time to be able to talk through that. Optimize based on risk return trade-off for two target positions. Now, how many currencies are there in the world that you can actually liquidly trade? I've looked at Costa Rica. I don't think you can trade Costa Rica's currency. I don't think it's a currency you can trade. So there's a lot of countries that have currencies that you can't actually trade. So Australian dollar, Brazilian real, British pound, Canadian dollar, Czech koruna, the euro. Now, the euro messed things up, didn't it? You went from like 15 currencies to suddenly you had one overnight. The yen, the peso, the New Zealand, Norwegian, Polish, South Africa, Swedish, Swiss, US dollar. I remember talking to Barclays when I was maybe responsible for currencies. We only had 3 currencies, and I asked Barclays if they would actually hedge our currency risk for us. And they said, we'll only do it if you have at least 11 currencies. 11. And that's the first time I heard that term, 52%. They said the goal is to be right 52% of the time. And if you only had 3 currencies, being right 52% of the time gives you a high risk. You could be wrong 100% of the time. You could be wrong on all 3 of them. But if you have 11 currencies, 52% of the time, you have some hope on average will do better. But that 52% is a really important number. If you want to be successful in finance, if you're 52% of the time right and you apply it to a lot of stuff, you've got a good chance of outperforming consistently over time. Now, if you're 52% right and all you're doing is looking at 3 stocks or one market, it's just not going to work. So it's 52% applied to a large number of opportunities. KAR, I don't even know what they stand for. Oh, this is Phoenix Investment Partners, small cap. They have 20 to 30 stocks. They have 20, 25 out there. They have another 150 out there. They look at valuation, diversification, their sales disciplines, price to target achieved, upgrade characteristics, fundamental revaluation. That's essentially nothing. And then again, their process. They start with the universe, bottom-up research, valuation analysis, decision to buy. At least 5 sectors at all times. So they're pretty concentrated. 5 sectors. That's, there's only what, 11 sectors now? 5. You can leave out over half the sectors in your analysis. That's pretty aggressive. And this is international too. That makes it even more ridiculous. Their benchmark is EFA, so they're probably on developed markets. And then if you're going to do international, you have to address the currency issue. Are you going to hedge currencies or not? Most don't hedge the currencies. So if they're 20% in Japan, they're 20% yen. So you have to address those type of issues. Here's Wellington. Wellington's kind of a precursor to Vanguard before they split up. So a misunderstood negative effect, consolidating industry structure, return on capital low, but improving. Sounds like that previous one, right? Looking for bad situations that are getting better. I actually kind of like this approach. I've actually thought about doing this. What if I take the market and just take the firms who have kind of decent 8-9 year performance, but recently have done really badly? And let me just look at them and just see what's going on. So maybe their sales growth for 8 years up to the last 2 years was 7-8%. But the last couple of years has been negative 20-30% because of COVID or whatever. Looking for those firms that really got destroyed. Maybe there's something there. Now, there was one firm I talked to. This one's really interesting. Is that their philosophy was it's really hard to find good companies, but it's really easy to find horrible companies. And so their process was to rank companies from worst to best, and just get rid of the bad companies. And they thought they were better at identifying bad companies, good companies. I don't know if I would be good at that, but that was their approach. They were called Brandywine. I don't know if they're still in business. You could look them up. Brandywine, they're probably going out of business by now. Proprietary, see how many times I use that? What does proprietary mean? This means that you built it, right? So proprietary earnings estimates, projected relative PE multiple. So it just means they're using their own numbers. They're not pulling stuff out of Bloomberg. They get a projected target price. They compare it to the current price, and they look at the appreciation potential. Westport. Bay is, sometimes you get it as a circle. You're getting a sense of this. This I like these type. They own firms that have a global prominence, have good management, they're high quality, they have above average earning per share. I think they mean either margin or growth. And they're one of the leaders. They want to be number 1 or number 2 in market share. Boy, you went from 20,000 stocks down to about 50 really fast there. Does this actually work? Who knows? What firm is this? There's another firm. Don't name your firm. How do you say that? You got 2 words. Fayez Sardi. Why would you ever name your firm that? That just makes no sense whatsoever. Here's another one. Quantitative screens, fundamental analysis, portfolio construction, sales discipline. That's like another one, apple pie. But nice thing here is they go through each one. What does quantitative screen mean? And they give you that. What's the fundamental analysis? They look at operating earnings, enterprise value, kind of a return on equity kind of return on capital using market values. Corporate governance. A lot of y'all did a really good job in paper 2 talking about ESG and really interesting stuff. It looks like there's a lot of stuff out there. Conservative accounting. How does Warren Buffett define conservative accounting? how much of their earnings is related, it's dependent on reserves and liabilities that are estimates. I know in the insurance business, you can get whatever net income you want just by changing your reserves. The errors are anywhere from 50 to 150% of net income. Warren Buffett doesn't like business like that. I know he owns Geico. Geico's a little bit more straightforward, but he doesn't like life insurance companies. Portfolio construction, diversified by sector, factor alignment. So they're going to allocate based on what their model's telling you. And their sales discipline, predicted by the process, management guidance, actually reported. They're looking for earnings and earnings releases. How much of a surprise is that? And if it gets too expensive. So Epoch, this is the guy who wrote Shareholder Yield, a really good book. I've never invested with him, but this is very much a free cash flow focused firm. So it would be an interesting look. So if you're trying to find a good pitch book to use, I think this one's not a bad one to use. Analyze business as a private investor considering to purchase an entire company. That's Warren Buffett. Those businesses which we know and understand, evaluate business over a 3-year time frame, protect capital. So, and they have a process that they go through. All right, so you get the idea. So in this class, I used to require students to actually build one of these. And I replaced that and gave you 9 papers instead. So you're probably wishing you were in that old class. But students did a horrible job at this. It was like I was asking them to do something they'd never thought about before. And the next time they thought about it was 30 minutes before they did the project. And I was hoping for some really, I mean, this to me seems like it'd be a really fun project, wouldn't it? Sit down and figure out, what do I believe? What process would I use? That kind of thing. A lot of students say, wow, this is really boring. I don't know this. I'm like, well, why are you a finance major? This is what you do as a finance major, right? You want to start your own firm? This is what you got to do. You got to come up with this process, prove it over time, see if it actually works. If it does, yeah, you can have $2 billion, $3 billion under management. You'll be making $1 million the rest of your life. No problem. Yeah, it's pretty cool. Your own boss, all that kind of stuff. I do need to get more recent ones. These are all really, really old.
You have one that you built?
We built one for the Investment Society. Yeah. The one we had at USAA, I can't actually show you that one, but yeah, we built one from the Investment Society. We haven't used it in a while, but we did build one. We switched from that model to letting each sector build their own. But we didn't actually do pitch books because we've gotten down to the individual stock discussion, but it wouldn't be a bad exercise to do again. I like this kind of stuff. I get real excited when I hear one like this. We used to interview 300 to 400 firms a year. It does get kind of boring and tedious after a while because they start getting a little redundant. But if I hear a new idea, a new approach, well, my ears perk up and it's like, okay, wow, that's interesting. When they say stuff that's pretty radical, we want horribly managed firms that have done really terribly the last few years, but they got a product customers need. And someone's going to step in and fix this company. And say, well, it's interesting, right? Will it actually work? I don't know, but it's interesting. So yeah, maybe there's something there. Show me what you do. Go through the process. How do you find these firms? Give me an example of a firm that's like that. And they'll show me an example. Say, yeah, but I can see that. Show me an example that didn't work. Okay, right? You have to ask the right kind of questions, but I get excited about this kind of stuff. All right, Thursday night, our last class, we're going to go through the executive summary, your last paper. So I will be here tomorrow from like 2 to 5. I'll be here Thursday from like 4 to 7, but I think I have some presentations. So, if you definitely want to meet with me, give me the time you want to come by. And then after that, I'll give you times that I'm going to be here around my finals. So I can give you that time. If you desperately need more time, I'm not going to come up for every day next week. So what I'll try to do is, so if you desperately need time, email me. I desperately need your time and give me an idea of what times will work for you. So I can find a block of 6 or 7 hours where most of y'all can make it. That's what we can do. All right. They say that the FEC will be open next week. Hopefully that's the case. But this Friday, I'll email out and let you know specific like times I plan to be here. If I need to be more times, that'd be fine. I'm not just coming up here because if I just come up here, no one will be here. And I'll be sitting here for 6 hours and then I get up to leave and then 3 people walk in. It's like, okay, I'm hungry. I want to go home. So, I mean, I've got to grade paper. I got to grade somewhere in the neighborhood of 300 to 400 papers next week. So I need to be home grading, but I do want to help y'all as much as possible. Some of y'all have some real obvious things to fix that can add 30, 40, 50 points to your paper. You need to be meeting with me either by Zoom or in person, or I can't really help you. All right, let's get started. Last class. All right, one thing I want to talk about on these models. So today, I don't know, I built the semiconductor model. So a couple of things that we discovered. First of all, looking at the results, this is what Solver gave us. We got a decent correlation, 0.82, so it's pretty explanatory, but it didn't allocate anything to turnover whatsoever. So here's where you have the choice. What I like to do is take what Solver solved and put it on a different line. Don't Control X, Control C, copy it. And then on the line where you did this, you can add some stuff to it. I can say, well, asset turnover is important to me. So I'll take that out of gross margin. So at least I've got something in everywhere. I got something on turnover, something on margin. Now to me, gross margin, my word, that's just too much. I got to have something on net margin. I have something in return. Oh, that's a change in the EBITDA. Oh, you actually like that. That's the one we came up with, right? So I won't do that one then. But I need something on return on equity. I mean, any one of these. I'm going to do WACC because I like WACC. So what happened to my R squared when I do that? It didn't hurt it that much. And I got stuff in there in every category. So, so you can make those adjustments. If you think about what you're doing, you're trying to figure out what does the market think, and that gives you the highest R squared. But if your goal is just to figure out what that market thinks, then every stock's well valued, just buy the stocks, right? So you're trying to figure out what the market think, and then you go back and say, well, what do I think? Well, the market doesn't think this is important, but I do. So I'm going to put that in there. You don't want an R squared of 0 because that means, man, you're missing something important that the market thinks important. And if you don't know what that is, at least figure out what it is. If it's 85% on gross margin, you're like, well, my word, gross margin is not that important. Why is they focus on that? Then you cut that down to 20%, your R squared comes down, but at least you know. If you don't know what the market's focused on, you have 800 factors and none of them has an allocation of anything. So there's some factor that's important to markets that you don't know what it is. That's a pretty dangerous thing. So to me, the ideal is you start with an R squared of 83% and you see the market's focused on stuff you don't think is important, then you change the weights, and that's where you're going to find undervalued stocks. That just makes the most sense. The other thing that we had a discussion, I won't mention any names, but you got to be really, really careful. If you're going to use these factors, things like gross margins, turnover, return on capital, to forecast EV to EBITDA, what do you not want in your factors? If you're trying to forecast B, what do you not want as one of your factors? You don't want B as one of your factors, right? So anytime you see the word yield, you got to be really, really careful, because yield is when you divide something by price. And what are we trying to forecast? Something related to price. So if you use like an EBITDA yield is EBITDA over price. And you're going to try to do that to produce EV over EBITDA. What are you doing? You're using A to forecast A. You're going to get a really, really good R squared. But so be real careful on this side over here. Try to avoid having anything in your forecasting side that has price in it or enterprise value in it, because that's what you're trying to forecast. So as we were talking when we were building this model, some people really love dividend yield. What's wrong with dividend yield? Dividend over price, you're trying to forecast what? Price. So if I were using dividend yield, I would use it as a screening technique. I can say I only want stocks use dividend yields above X. But once I get those stocks, then I wouldn't use that in my my model because it's really easy for the model. If you got price and I'm trying to figure out price, it's just going to relate those two together. So be real careful on that. But this is a pretty decent model. I built one for I think for Alejandro, right? Is that you? Yeah, Alex, excuse me. So Alex, we had a pretty decent model for Visa. You can see here, I did the same thing. I took some out of the margin. I don't remember where I'll put it on whack. Again, got a pretty decent R squared, and Visa's number 2 and the most expensive. MasterCard's number 1 and the second most expensive. That seems pretty logical. And then there's the model. So that's a good looking model there. That works pretty well. Someone was asking, how many companies do you need? Is more companies better or is fewer companies better? And the answer to that is what? Yes, the answer to that is yes. It depends. If you're doing anything like consumer stocks, you're probably gonna have to have as many as you need. If you're doing semiconductors or you're doing like Visa payment processors, if it's a really specific industry, airlines, you really don't really need 50. If they're all doing really the same thing, because consumer stocks are not all doing the same thing. But airlines, payment processors, they're all doing pretty much the same thing. So here's one where we only have only had 28 companies, but we got really good. I mean, it looks kind of dense, right? Undense, whatever. It looks pretty sparse, but that's fine. It explains these companies really, really well. So that works well. And then Henry walked in, and we tried everything, and we got a whopping, what was our R squared? 3%. That was squaring -9% and 9. So yeah, we just could not get it to work. So I'm going to try on this one, broaden it out to hundreds of companies and see if I can get that to work. We'll have to just see, but it's not working. And the strange thing was on Netflix, I know Netflix is not a highly rated company. I was surprised to see they got upgraded by Moody's to investment grade, but they're a below investment grade company. But Bloomberg's default ratio had them extremely high quality, like the highest quality that you could get. So that's one of the few times I've seen Bloomberg's rating be very, very different than ratings. But anyway, the problem might not be Netflix, it might be everybody else. If I broaden this out I'm going to start with the Russell 3000. You can do that. You can put your stock against every other stock in the entire market. So I'm going to start with that, and we'll see how we go from there. It is tough because this thing includes Netflix. It includes AMC, which we know AMC, what's the chances AMC is well valued right now? It includes Disney, Chicken Soup for the Soul. And includes cable companies. We had broadcasters in there. We took the publishers out because we said, that's too different. I forget, we took out the Facebook, Google types out of here, the true internet kind of companies, but we couldn't get anything to work. So we had to give up. And then I'm thinking, I got a meeting. I don't have the time. So Anna, let's go as fast as we can. And then 20 minutes later, we had a good model. So you never know. It's not, some industries work really well. Some industries don't work well. All right. So you're at the point now where I don't know where I'll be up here again. So you're kind of on your own building these for the next few days. I did dump all the data I could possibly dump. So it's possible I could build another one at home. I do have one for where you saw what I have. So I've got the consumer stocks. That model's working pretty well. So I've got all of these companies are built. So if you don't want the 10% bonus, American Eagle, Best Buy, Chipotle, Costco, all of those that y'all are doing is in there. I thought Wingstop was in here too, but I don't see it. Maybe it was. Yeah, Wingstop's in there. I just forgot to bring it up to the top. So that's about a fourth of the class right there. We got Visa. I think we have more than one person doing Visa. We got the semiconductors, so that's 3 or 4 of y'all. I think that's all I've been asked to do. So if you're not in that group and you want me to build something, then you're stuck with what I have here, which is I don't know how many companies that is. I got 3,028 companies, and I brought in all of this data. I brought in all the data I had for the consumer model. And so I'm kind of stuck with that one. So I might be able to build that. I can't remember if I had any valuations other than EV to sales. Yeah, I got EV to EBITDA, EV to sales. So price to book's not in there. So we kind of stuck with me not having that one. So it's possible I can build more models. I was kind of somewhat surprised Bloomberg let me bring in that many data points. You're probably going to get an exceed data on that machine next time you log in that machine. That's a lot of data to bring in, 3,000 companies and quite a bit across the way. So it's possible. I did email that to myself. So it's possible I can build a few more models, but if you haven't gotten your model yet and you want me to build it, we're running out of runway. I know y'all think I'm going to sit up here 50 hours next week doing stuff for y'all, but I got to grade a lot of papers next week. So you're kind of on your own. Or hope I can get something out of here. But if you're one of those companies, as I just showed, you can use that model. We do have it and it will work. All right. So I was impressed with Visa, MasterCard. That worked pretty, and that's exactly what you would expect, right? The two monopolies are dominating this industry, exactly what you would think. I forgot to say what was cheap and what was expensive. So on this one, we rank Visa second, and they're actually the most expensive. So they're expensive. MasterCard is cheap. So the cheap is up here and the expenses is down here. But essentially Visa is well valued. I mean, that's, that's about tied there. All right. Anybody else come in late here? I can't keep track of it all. Sophia. Anybody else? Okay. Oh, Sergio. ¿Dónde está? Más.
Okay.
All right. So I only have one last thing to get through. Hopefully your technicals are working pretty well. You can get a lot of that online. Has anyone tried the BTST yet? Let's see what they had. Could you do everything from the BTST? I mean, that's one paper you could probably do in 2 or 3 hours just sitting at a Bloomberg terminal. And the Bloomberg machines will be open next week. So that one's definitely possible. Going through the Bloomberg market concepts, I was telling one of our students, a freshman wants to teach a class next semester. And I told him, boy, you could just do Bloomberg market concepts, just the terminal basics as an entire class for the entire semester and do nothing but that. And actually for the sector wars next year, I really think what we're going to do is the students come in on the sector teams, just tell them watch that video because it shows you, and they show you all the functions you can go through and get a really good quick list on stocks and their values. So yeah, there's some powerful stuff. For paper 7, there's some stuff in Bloomberg I found really, really interesting. Some really cool charts that I might add next time we do this class because it's really, really interesting stuff. All right. So the last thing you have is the exec summary. This is the easiest paper and the hardest paper in some ways. So it's easiest because it's the shortest. You want to try to keep it to 1 page. It's hard from a standpoint that you've got to step back and look at every single thing you wrote and figure out what the most important things are. So you got to figure out what do you include, what do you not include. It can be in some ways the most important paper because if you're going to put this on LinkedIn, it might be the only thing they look at. They may look at this in detail and then they flip through everything else. And they're impressed by all the pages and the pretty charts, but they don't actually stop and read. So from that standpoint, you've got to make it as pretty as you possibly can. You want it to look sell side. I would say, you could do a buy-side research, but there's no such thing as a buy-side research report.
I've noticed that some of the papers have like a title cover page and some don't. What would you recommend?
Yeah, I don't like title pages. Looks like a college paper. The first thing should be target price, $57 currently, the first thing should be your recommendation. College students write cover pages. Students ask me about cover pages for resumes. It's like, what are you doing that for? Or like my objective. Your objective is to get a job, I think. Right? Is that hard? What's your objective? I mean, it's like, why add extra stuff for them to do? So yeah, keep it to one page. So it's sell side. So the sell side, sell side's great to work in because it looks good on a resume, good experience. It's long hours, but it's not long hours because of all the work. It's long hours because you're waiting for stuff to show up. When it shows up, you got to do your job, and that might be 8 o'clock at night. So it is long hours. It's a lot of PowerPoint and fancy things, but it's a cool job. The sell side that I saw, it's a lot of travel. So they went around all their clients, had lunch with them. There's a lot of lunches. And I remember lunches. I remember a utility guy. Boy, I said I was supposed to do utility stocks and I never could figure them out. But just having lunch with this guy thinking, man, if I knew half of what he knew, I'd be really valuable to my company right now. Unfortunately, I know 1/1,000,000th of what he knows. But he just went around and just top of his head. I didn't know Homer Simpson was a term in that industry. I thought he was joking. He says, yeah, they got a Homer Simpson going on. I go, what is that mean? But talking about the risk and danger of certain utilities. And it's like, okay, I get it. It made sense to me. I watched The Simpsons. And this was like 40 years ago, right? How long has The Simpsons been on TV? It's a long time ago. So they know their industry. They're very, very, very concentrated. They're not following 200 stocks. They're following a short list. They know their companies extremely well. They're the ones that are allowed to call in on the conference calls. And so they're very detail oriented, know exactly what's going on with their firms. The firms know them really well because they interact with them a lot. The investment relations people do. So that's what you're looking for, is someone who can, in a nutshell, explain your company. I love listening to Dan Darren when he does it, when he can explain Uber or explain some firm in just a few sentences, and you understand exactly what are you investing in. What's the main thing this firm's got to get right for you to want to invest in it. The business breakdowns that podcast does that in a little bit lengthier way, but that's what you're trying to do. Your goal is to figure out what's the single most important stuff to put on that first page. You want to have some charts, so you need to think about what chart. That football chart is really a good one to put on the first page because it looks interesting and it's also really important, right? What's the range that you could expect? Where is it currently trading? That would make a lot of sense. They usually put target prices on the first page. I'm not a target price person because I don't think we know what anything's worth in the stock market. But that tends to be what people do, is the target price. So the target price might just be the middle point of all your assumptions. Figure out what charts you're going to do. You could put the paper 7 chart in there, but just think about it. Look at some of the example papers. I'll show you some today. I say 2 pages. You really, really want to get this to 1 page. Probably 2 columns. Some people do 2 columns, or 1 column's really wide and one's really narrow, and the narrow one does the charts. Find some way to make it look good. One thing I'd say is pick your color. Is it blue? Is it green? Make it look the sell side. JP Morgan does blue colors or whatever. You expect those colors. So have something that makes it look professional, good. So you're going to spend a lot of your time here just on formatting. Formatting is one of the things I do great on this paper. Does it just look like a sell side research? And make sure you focus on the most important things. So one thing you might do is go back to paper 1 and say, okay, if I had to summarize paper 1 in 2 bullets, what would it be? If I had to summarize paper 2 in 2 bullets, paper 3, just go through each one. And that's going to give you 16 bullets, and then try to get those 16 bullets down to 5 or 6 that you're going to talk about. Right. This is the hardest thing for college students. Most college students are, let me summarize the 72 most important things for this company. And that's not what we do in real life. If you listen to Darren, he can explain Uber really, really fast. And it's not 72 things. When I had Jason speak to this class, it was so much fun because people just throw out a company, Google, Alphabet, Apple. He could, in 3 sentences, tell you everything you need to be worried about with those companies. Off the top of his head, he didn't need, he didn't even need the sell side report. He could do it really, really quickly. That's what you're trying to get to. And college students, we get in this habit, it's all about volume, right? The more stuff, the better. All that volume did, papers 1 through 8 is what? To try to figure out those 2 or 3 things. You got to do those 8 papers to figure out those 2 to 3 things. So it's, your family's probably going to think, my word, you got 2 or 3 things. That's all you know. It's like, no, I know these 8 pages, but the most important thing I know is that these 8 pages summarize to these 2 or 3 things. And that's the hardest thing to get that down. So focus, focus, focus. Terms like the most important thing they get right now is this. This is the key. As I told you before, phrases like where I think the market has it wrong, those are phrases that are extremely exciting. So my analysis biggest risk is we should be focused on blank and give it some time over the next few. You want to say, hey, should we focus on margins over the next 20 years? That's not going to work. You need something that is, remember we said catalyst, something that's going to happen here in the short term. That's on the sell side, that's what we're looking for. You think about it from your client's trying to make investment decisions. You tell them, hey, they better get this product in Europe right, or this thing falls apart. And you'll figure that out in the next 3 quarters because they're doing this right now in Germany. Wow, that's good information. You know exactly where to focus and what to do. So yeah, that's the kind of thing you're trying to get to. Storytelling is very, very important, as Darren says. So yeah, what does the market not get about this company? Use a few charts, but make sure they're very telling. Try not to pick the charts because of the prettiest charts. If you got a chart that's not pretty, but it's really important, and clean it up some way. You do want really pretty charts on the exec summary, but you want to make sure they're telling you something. You can have tables of numbers. This is where the football chart probably works a little bit better. If you can find a way to put it into a chart, or if you can do a table with few numbers, don't have tables with massive amounts of numbers. You remember the table you put at the end of paper 3? That's way too much data. All right, so don't show that. Make sure you start with your final conclusion. The first thing you should see somehow, is this a buy, a hold, a sell, a strong buy, a strong sell? That should be prominent at the beginning of your paper. Usually the first thing is what's your target price, what's the current price, and what's your recommendation. Sometimes you can have bullets up front. If you have 1 or 2 things you can say, you can put that right up at top, be almost your title. Firms starting to turn around firms turning around and market doesn't see it. That's pretty exciting. They're fixing, firm being fixed, market doesn't see it yet. Does that excite you as an investor? Yeah, that's exactly what you want to hear.
Yeah.
Sorry, got somebody. All right, can y'all tell who it is? Not this Alejandro, right? That's okay. So yeah, get that early up. You can use bullets and bolding and all that kind of stuff is important. The font can be fairly small here, but you don't want to, don't go down to 8 or 7, but you can get down to 10 or 11. It can be, if you see some of these, and I'll show you some, they can be fairly dense. Be specific, be bold. One of our CFA research teams, I thought it was actually a pretty strong team, but they decided, we're really not sure about this. So we can say, yeah, we're pretty uncertain about this stock. We think it might be overpriced in these cases, but it might be under. No, that's not going to work. If that's the way you feel, then start pretending. Flip a coin. It's like, I'm bullish if it's this, I'm bearish if it's this, flip a coin, and then dive into that. That's the sell side. You've got to, you almost have to just discount. I don't think that's right to do in the buy side if you're really doing this and buying stocks. On the sell side, there is a marketing aspect to this. So make sure and make it really, really strong. So sell side examples. Any questions up to there? Y'all see what you're after. You have some pretty good examples out there. You have some not so good examples out there, and the ones that we did. Some of them look like sell side reports. Some of them look like college papers. Which is your goal? You don't want any more college papers, right? I got a paper last week that was double spaced. No paragraph breaks. It was like, that's almost, high school with no paragraphs, no breaks. And it was in my other class. It was like, yeah, it looks like a paper written by a student. You got to get out of that mode, and you got to look like something that could be published. All right, so let me give you a couple examples here. So that's what I say. The marquee. I've had some students actually create their own marquee on these things. That's pretty cool. Yeah, the marquee. Date is important. I used to have a boss that if I gave him something and have a date on, he just ripped it up. So, was this written yesterday or 12 years ago? I don't know. I mean, how can I make a decision on something I don't even know how dated it is? So the company name, obviously very important. They have a lot of wasted space here. They got the ticker, they got the target price right there. Pretty prominent, right? So what does software initiation mean? So software is the industry. What does initiation mean?
The sector.
Not the sector. Here what they're saying is this is their first time to look at this company. Yeah, initiating research. One of our students from Goldman Sachs, they did an initiation report on the healthcare companies, and it was really impressive. I should have brought that tonight to show y'all, but it was really, really impressive. That one, they did an industry analysis first, and then had a separate page for each company. And they just went through each company. Really, really, really impressive throughout. All right, so you can see they're doing the wide column with the narrow column. They're doing bullets. Initiate, outperform. We like them as an industry leader product, which is strongest in the mainstream market and continue to encroach in the high end as well. All right, what does that tell you? It's got a great product. It does something that competitors don't do. That's good. It's strongest in the mainstream. Well, that's good. That's the biggest volume market, but it can go on the high end. What does that mean? More margins. That's kind of nice. All right, I'm kind of interested. That's good. What do they sell? What is Altium? Anybody heard of this company? Someone looked them up. They're software, obviously. They're probably out of business now. Probably trading for $3 or something. Who knows?
They're actually traded for 30.
They're where?
They trade for 30.
30. Well, they may have done a stock split. You never know. Second thing they say is industry growth led by proliferation of electronic devices, which could only be further supported by Internet of Things. They've got the Internet of Things in there. High profitability and cash flow generation, driving earnings yield and dividends, and still allowing for reinvestment. I mean, there's some good stuff in there. It all makes sense. The sell side I really, really hate is when you already don't know 7 of the words in the first sentence. There are some industries that are so technical that the jargon comes in immediately. So I try not to find any here. This is a firm that it could be like that because this looks like a fairly technical firm, but they've done a good job of not being overly technical. The business leading PCB design software. I hate acronyms, but did they define the acronym? Printed circuit board. Do you know what that is?
They were 15 cents in 2010. Now they're $43.
Well, that's probably because they're doing the stock splits. Maybe if you're looking at an adjusted price, they probably really weren't 10 cents. They're probably $20, but they've done some. 10 cent might be a stock split time, unless they got bought out. 10 cents is usually going out of business. I don't know what a printed circuit board is, but at least they gave me the acronym. I've seen a lot of sell side where their acronyms throughout with no explanation. Never use an acronym. You don't say what it is. So they develop and sell a range of software products centered on printed circuit board design. Sales are global. A mix of recurring, not sure what that means. I guess this is a product you have to buy over and over again, some of it, and non-recurring. And the flagship design is supported by adjacent revenue streams. So there's other stuff they can do. That all's good. That's the kind of stuff you would want as an investor. Industry transformation supported by structural tailwinds. That could mean a million things, but it sounds good, right? It's a real fancy sentence. The word tailwinds is always good to put in any paper. Having already become a dominant mainstream product, the high-end and enterprise market is increasingly attainable. Their product provides a longer dated cloud-based transformation potential. I don't know what that means. This market share opportunity is on top of semi and electronic design, automatic growing at the mid. So this is the jargon side. You're not going to understand all this unless this is your industry. If this is your industry, you don't understand that, like I was with utilities. I'm just sitting there with shaking my hand. Yeah, boy, you always go, wow, that's interesting. I hadn't thought of that before. I don't even know what any of that means. You don't say that last part, but yeah, you're just like, yeah, wow, really interesting. So I would have to figure out all that is. I remember doing some of my first sell side. It's like, boy, I'm the stupidest person on the planet. I have no idea what any of this is. Are they saying this like you already know what all this means? Right? They don't have footnotes. They see what, so that's when you start Googling all these type of terms and see what does that mean. Highly classical generative. That's nice. EBITDA margin is 40%. Wow, that's really good, right? What was Casco? 3%, right? So off the bat, they're 15 times with all R&D expense and potential. That's good, right? It's going right through the income. They're still 40% EBITDA margin, even though they're expensing all R&D. For even higher margins of direct sales and scale benefits continue. High levels of reinvestment occur. R&D is 15% of revenue. That's really impressive. You got a 40% EBITDA margin and 15% is going to R&D. Yet a dividend can still be paid, grown by 20%. Yeah, I want to go and buy this company. So valuation, we initiate a $42 target based on 50-50 blend of a DCF model and then a relative value model. Now, is this really DCF model or is it DCF for 5 years and then a relative value model? Who knows? But they say it's DCF towards the top end global peers. So here they just took what's the typical range for this industry? 17 times on revenue is a ridiculously high valuation. That sounds like a PE ratio, doesn't it? And they're doing that as a EV to revenue. And it's on forward revenues. What does forward revenues mean? For a firm that's growing 20% a year, that even makes it look more expensive, right? Because the forward revenues is bigger than the current revenues. So that's kind of concerning to me. But they're saying that's the normal for this industry. Okay. Key risk. I might have separated that as a separate bullet. Key risk, competition. Tell me a company you're not going to say that. Maybe MasterCard, Visa, right? But their penetration, you already talked about delivery on 5-year targets. That's probably true for every company. Electronics industry activity, I have no idea what that means. Sector valuations, so maybe the whole sector is overpriced, and foreign exchange. Key catalysts, all right, I like that word. You got the word catalyst in there. I don't know what achievability means. Why would meeting your goals be a catalyst? I don't understand. So I'm not really with them on that. Particularly sales estimates with the 1H21 result, a key update. That sentence means nothing to me. Anybody want to translate that? So I should have picked an insurance company because I could probably figure that out. But
Probably in the past, the guidance, they haven't met their
And then
whatever.
is it management's guidance or
Probably
the streets?
guidance.
And then they've been talking about this getting this product into more places. Okay, so that's a catalyst you can measure. That first one, I don't know what that means. I mean, that's the key. The catalyst should be what? Something you can go check. You can't say the catalyst is, well, I don't know if I can think of one, but something you just can't go out and check on it. So
Some sort of market check.
the first one you're talking about, or
Like some sort of market check that like.
yeah, customer satisfaction. If you can't measure it, but if you know, I want something I can go out and say, okay, yeah, they hit that number, or they didn't hit that number. That could be a catalyst, and then you could see what those sales are. So if we're assuming breakfast sales are going to become 20% of their revenues, and that's a catalyst, then yeah, you could look a year later and say, oh, they're 30% of sales. Wow, this really did work really well. But this penetration, you can definitely, you know, ask their market share. You look at the sales growth there, how many customers, those kind of things. You know, Netflix, number of accounts, that's the main thing the market looks at. So if you say the catalyst is they're going to spread to Africa or whatever, then you start looking at those numbers from Africa. If you say they're going to spread to Africa over the next 20 years, that's not a catalyst. I don't have that much time. Say, okay, boss, wait. We're looking at Netflix sometime in the next 20 years, we're going to buy. That's just not going to work. All right. So can you get your 18, you know, should I expand it to 18 papers? Can you get your 8 papers into that short of a paper? All right, you see what you're up against here. How much of this was industry specific? A little bit of it, but not much. Most of it's very, very company specific kind of stuff. Now, when someone says they're going to penetrate their product, I would love to see what competitor they're taking product from. That would be really interesting to me. And they don't say that. If your market share is growing, then from whom are you stealing? If you're stealing from Oracle or Microsoft, something like that, that might not be a problem if this is 1% of Oracle's business. If this is 40% of Oracle's business and you're stealing market share, what does that mean? You got a gorilla that's going to fight really hard. That's not good. If it's 1% of business, yeah, that's great. I love businesses that are growing fast, you know, taking market share at the edge of a really, really big business. That's great because they'll let you have it. They say, hey, take it. We don't want that business anyway. All right, what kind of things they put down here? They put some forecasts here. This wouldn't be a bad thing to put into your paper. This is not in fact, this is pretty common. Take some key data, put the last actual, and then put your forecast there. That can be a really good thing to do. Football chart, but the wrong direction, right? But there's our football chart. I don't know what this is. Anybody know what that is? Performance, 1M, 3M, 12M, relative. I don't know what that is. Yeah, that's really strange.
Months.
That's 1 month, 3 months, 12 months.
17% under relative performance for the first.
So that's their 1 month return, 3 months return, 12 months. Okay, boy. I'm thinking 1 million. So, okay. And then you don't have to put the disclaimer at the bottom. That's fine. You know, if you're worried someone's going to take this and buy a stock and then sue you afterwards, you know, you can put that in there at the end. But a little bit of that over here to a price target. I mean, the current price, the market cap. I don't know if, boy, monthly trade, I guess if you want to talk about liquidity. Projected return, boy, that's like the most suspect. Yeah, who knows if the market crashes 30% next year. It's like I was telling my other class, I saw an article from Seedfield. The article said oil prices might fall 10%. Wow, it's useless of information you can give me. Oil prices could rise 10%. So someone says oil prices will fall 10% or more in the next few months. That's useful information. But telling me something might happen, that's kind of what this is, right? This is kind of, I don't think, I would not put this into your paper. First of all, that's something that's really easy to check a year later. They were down 42%. We thought they'd be up 20%, but you know, that was our best guess. This is 2020 after COVID. So probably good chance they made it, right? I don't know. Someone will look at their 1 year return. Are they up 20%? But all right. So you get a good sense of what it looks like. They even have white space in here. That would be a really good thing. Get everything you need in there and still have some white space left over. That would be quite the challenge to do. So But look at the fonts. The fonts are pretty small. Look here. This is really small stuff. You can get, I don't know what that is. That's maybe 9 or 10 there. But pretty small stuff. And then they have all the other stuff, you know, the rest of the report. Not nearly as long as what you did. But there's some, you know, similar stuff to what you did. I don't know how many pages it is. 53 pages. How many of y'all hit 53 pages yet? You there? But your font's probably bigger than that. So they have a lot more charts than you do, right? They even have a glossary of terms. There's your senior management. See above, see above. All right, so you're doing stuff as you're doing more buy side until you get to the exec summary, and then you're going to do more of the sell side. All right, so here's one you probably understand a lot better. Here's Cohen, Jack in the Box. Now, I think Jack in the Box is company-owned stores, somewhat like Starbucks, not McDonald's, with the franchise. So we'll see. I think that's the case, though. When's the last time you ate at a Jack in the Box? Just out of curiosity. This year. How many have eaten at Jack in the Box this year? Anybody? Never been? They had a comeback during my time in college because they did this commercial that actually got them in trouble, but they came with a funnier looking Jack in the Box head that came out. And then they decided to change that, and their commercial was to blow that thing up. And they said parents were calling in because their kids were crying. But they did have a comeback, and I don't know lately what they've done. I think the biggest problem Jack in the Box has is they sell way too much stuff. Nothing they sell is really good, but they sell everything. They have tacos, salads, hamburgers, chicken sandwiches. They just do everything. So what are they recommending? How long does it take you to tell you what they're recommending? You know, you can't tell, can you? All you can say is the current price is 86 and the target price is 90. What would that recommend? Probably be a hold, right? But they don't say anything. You need to say that up front. You can put your name over here like this if you like. The first time I saw a UTSA alum like that, it got me really excited. I wish I could show you his report, but they keep deleting it off their system. But Ryan was the first one I saw at JP Morgan. He was the last one on the list, but he was on there. He was a newbie. He'd only been there like 3 months. And he got his thing. And I go, well, you know, they put you last because you're the newbie. And he says, yeah, but I wrote that entire thing. So I should have had my name first. But anyway, what else do you notice about these names? CFA. CFA, you think Andrew's feeling any pressure? So maybe he is the newbie. Even put their phone numbers on there and emails. So if you can do something like, I mean, that's fine. Just make it look professional. Notice on the price, they gave the date. The price target is tied to the date of the report. This is the challenge you have. You've been writing this thing over 3 months, and now you come to the end and you're like, what do I do now? You know, the stock price is up 20%, down 20% since I wrote paper 4 and 5. Yeah, you're stuck with it. I mean, here you don't have quite that problem. We are pleased with the top line driven EBITDA beat, existing fourth quarter with 13% comps that have encouraged and persisted. We look forward to learning more about the sustainability of their brand success beyond COVID-19. Additionally, I don't know how they got through COVID-19. They must have done some DoorDash and other things. I can't even think where there is a Jack in the Box around here. Is there one anywhere in this side of town? I can't quite. I think I've eaten in Jack in the Box in the last 20 years, but I can't remember what I got. Fries, yeah. They used to have this meal thing that was really good, and they stopped offering it, but it was pretty good. But it was way too much. I mean, they were doing everything. We look forward to learning how recent sales strength is impacting development pipeline. I don't know what development pipeline means, if that's new stores or new distributions. Jack is looking to hire a CDO. Anybody know what a CDO? development officer and improve development processes. So everything's talking about development. Boy, that got me curious. Development of what? What are they developing? Huh?
More food.
Yeah, well,
More choices.
you don't want to expand it. I think that's the same problem I have with Dairy Queen. Dairy Queen has way too many things on their menu, and you can walk in there and you can tell. It takes, I don't know if y'all been to Dairy Queen in a while, it takes way too long to make stuff.
Yeah.
And so you go in there and you're like 30 minutes later and it's like, what do you want? And they're like, you asked for the wrong blizzard. You can tell they don't like making them. Sometimes you need to simplify. I think that's the advantage McDonald's has. They can cook stuff fast. I think I told y'all that story. I worked for McDonald's for a month. And going from breakfast to lunch, it was 3 seconds. This guy got a scraper. He scraped off to breakfast and he threw hamburgers down. That's the kind of business you want. It's got to be simple, got to be fast. And Dairy Queen and Jack in the Box, I think it's too complicated. Do you want a business that it takes 3 or 4 days to train a new worker when you got new workers coming in just all the time?
Why does Warren own it? That's the question.
Yeah, on Dairy Queen, I understand. One thing I think if I were a firm, I would do like the barber shops and I would have a training franchise.
Right.
I would have a McDonald's with all my new people and everything's 20% off, right? You know, there's some of these college barber shops. Everything's 20% off. You take all your new workers and they start there and they work there for 3 months. I think that'd be a great idea because I just think it's really stressful. You have a business that's already not that fun to work at and you have a new person work in and you say, go mop the floor. And it's like, how do you do that? Well, there's a mop for what I do, which end, you know, you're like, okay, I need to serve these customers. It's really frustrating. So I think that's my big complaint with Jack in the Box. It's just too complicated.
Alan was telling me that Waterburger, Alan Lampard, that Waterburger actually has like Waterburger University. I think it's off 35, but it's just like for those like being
Management.
promoted to manage.
Right.
Yeah.
I'm talking about for entry level
So just
people.
for focus of like.
Yeah. I mean, it might seem like it's overkill because they're going to quit 6 months later anyway, but I still think it's better having them there and messing up and then sending them so that they hit the ground running. You know, a city like San Antonio, you could have 3 of those training around the city and they could all go there. I just think, you know, I'd love to try it. Jack in the Box reported fiscal EBITDA well in excess of the estimate. The beat was driven by same-store sales of 12. Wow, that's pretty impressive. Boy. Relative to our 8% estimate, 8.4 consensus. Following disclosure of third quarter earnings call that the strong comp trends at the end of the quarter persisted into the first 4 weeks. This implies comps, you know, so this is a very short-term focused report. What happened recently, what's happening right now. They keep using this word development. They haven't explained that yet. So that's what I'm looking for here. So this one somewhat frustrates me. They hired a new CDO. They're talking about development. What does that even mean? So can I do a search on that? It's in there 4 times. We are looking to better understand if the development pipeline has been accelerated from 18 months, more flexible prototypes that require less construction time. All right, so they're talking about just better store designs. That can be somewhat an interesting they need to do. The impact of sales from closed California indoor dining, 42% of their store base with 94% population residing. What needs to happen for share purchases, repurchases to resume. So they're giving you the most important things in a really long sentence, which is fine. And the upcoming menu innovation pipeline given Jack's innovative spirit. Boy, I kind of wonder if they work for Jack in the Box. You don't want that kind of positivity given Jack's innovative spirit. That's just, now who is Jack? That's not even capitalized. Is that Jack in the Box or there's some guy named Jack working for the firm? I don't know. Jack launched the plant-based unchicken sandwich in 3 markets. What is that?
Beyond meat.
Beyond Meat. All right, so they still haven't explained to me what this thing means,
Another product to their menu.
as well as developments relating to the issuer. Yeah, there's, so the format looks okay. It looks like a sales size report. It's really packed dense. They could have done a better job of saying this paragraph is talking about this paragraph is talking about this. I don't mind this approach of one really long sentence. I might highlight certain things bullets look a little better. If you're saying these are the 6 most important things, and 6 bullets usually works a little bit better than having to read that whole paragraph. Evaluation methodology, how to value restaurants. And the rest of it's just boilerplate kind of stuff. Boy, that's. Right, so you want to try to get as much as you can. So let's look at one of the student examples. I always like to do Coca-Cola because he's the one that got the first job getting published like that. Where are they? Where are they? I know I'm looking right at it. Higher. Okay. So he really did a good job making his look sell side. Now, what's his recommendation? How long did it take you to figure that out? Oh, saw it immediately, right there. Current price, the date. That's a good format. What is he showing here? That's not a bad thing to do. If I'm a portfolio manager, that's kind of the first thing I ask is, well, how's it done the last year? I'm kind of saying, you ask me to buy a stock that's grossly underperformed and you think it's going to recover. You find a stock that just got strong momentum and you think the momentum is going to keep going, and I'm kind of worried that maybe it's overpriced. This is a stock that's pretty much been in line with the overall market. His price target was 38. What is Coca-Cola's current price? Make sure you use KO, not Coke, not Coke. What is their current price? 53. So this was back in 2015. So you'd have to look like in 2016 or so and see how it did. Look what he's doing there. He really wants us to be sell side. So we're initiating coverage as if he's working for a firm, right? If you're working for JP Morgan, he's going to say we. Initiating coverage. Well, you could put it that way because that's essentially what you're doing, right? Is this the 3rd research report you've written on your company since you've been at UTSA? Is this your first one? So are you initiating coverage? Yeah, that makes sense. You might look back at that first one and see how they put that in there, the industry and initiation. We don't believe the short-term outlook for the industry is favorable, and we think the negative top-line growth they face may persist for longer than a year. Coke continues to maintain their market leadership position, and management has taken significant strategy moves to stem the decline, which mitigates a sell recommendation. That's very well written. If I'd read this in a JP Morgan report, I wouldn't think, oh, this is a college student. Where did they get this guy? That's very, very well written, very succinct, very clear. I mean, you know what to look out for, right? They're having some top line problems, but they're still a leader in the industry and management is doing stuff. Now, what's your question? So what's management doing? What are these strategies they're doing? Would I believe those? He starts off with catalysts. Yeah, that makes a lot of sense. So he's saying growth can be a problem. What could be growth? We believe geographic diversification in developing markets will mitigate the losses in top line growth in developed markets. Joint ventures and investments in the high growth players such as Monster have the potential to boost yearly sales by entrance into new markets. Investment risk, failure to realize benefits from acquisitions. Now you're curious what acquisitions are they doing, but obviously they're trying to get into the water and the tea and all those kind of things. Increasing debt, deteriorating fundamentals may continue to pull down valuation if not turned around in the near future. Our valuation implies that it is traded at or near fair value on most metrics. We believe this is justified by the strong uncertainty regarding future growth. Investor sentiment on Coke also appears to be negative in the short term. So even brings in the technicals. So you're asking, how do you bring technicals in there? You might, that's one way you can do it. If technicals back up what you're saying, hey, not only am I negative on this stock, but looks like the market's negative on them right now as well. So this is not a good time to get into the stock. We believe they're positioned for growth accordingly, but given the recent non-value adding acquisitions, we are not swayed towards a buy. In fundamentals growth or turnaround, then KO may soon see a strong rally. So he's just set himself up to say, okay, boss, I'll let you know. This might be on my buy list in the next 6 months. Right now it's not, but you may be seeing it. Okay, so kind of setting your bottom up for that. He put returns Yeah, so he's doing the same thing. I guess I'm not used to capital M's, but that looks like 1,000, 3,000, 12,000 to me. Cash flow and growth valuation, he puts, we didn't have the football chart back then. He could have done a football chart there, right? His relative valuation. So he essentially put papers 6 and 7 right here all together. And then he did the company data. It looks real similar to the Credit Suisse one. I don't know whom he copied. He went to JP Morgan. I mean, this is the guy that was working for JP Morgan. Did I tell you his story? He's working at JP Morgan in their ops here. And he told his boss he wanted to be an equity analyst in New York for JP Morgan. And his boss said, yeah, good luck with that. He kept after his boss, and his boss finally said, okay, shut up. I'll call a friend in New York. You can talk to him on the phone. The boss thinking you can talk to him on the phone and he'll never talk to you again. Ryan convinced him, said, let me write a report for you. And he said, fine, it's Friday. Send it to me by Monday and I'll look at it. Guess what Ryan did all weekend? Wrote a really, really good report. He sent it to me and he's like, any edits? Like, no, this is a really good report. And he was working at JP Morgan that next summer and was getting published. And he emailed me and said, I'm going to stay on the sell side for at least 3 years. And then 3 months later, he emailed me to be a reference for a job and he moved to the buy side. This guy's a go-getter. I mean, he knows what he wants and he just goes after it. You kind of have to do that with this stuff. You kind of just, you got to step out there like you're the smartest person in the world. And guess what? If you're not the smartest person in the world, you'll find that out. But at first, you just got to go for it. And then if it doesn't work out, then you change majors. Like me, I was music education, didn't work out, so became an accounting major. That worked out, but then became finance major. You never know. You just step out there and see what happens. And if it doesn't work, they can't kill you. They don't shoot you for being a bad employee. Maybe in another country they might do that, but not here. He does have a table of contents, which is fine, and then he's just got the rest. You see, what is his color of choice? So he's blue. He's consistently blue throughout, even in his footnote. I mean, he's not thinking, I got to get a grade in this class. He's thinking, I got to sell myself. My name is on this paper. This is my advertisement to the quality of my work. How many of y'all would say, boy, I wouldn't put my name on that? Is that what anybody's thinking? Boy, that's shoddy work. I'm sure glad that's not mine. Anybody thinking that right now? This is pretty good stuff, isn't it? This is impressive. I remember I showed this at a conference once and they're like, there's no way an undergraduate student did that. I said, yeah, they do it all the time at UTSA. You're thinking Harvard or Yale or something, but no, these are UTSA students. So his idea is, hey, I'm trying to set up the rest of my life here. I'm going to write something I can sell that has my name on it. And he did it. He did a good job. It was really, and if you randomly go through here and start reading something, it's still very, very well written all the way throughout. He edited it. He made sure it was clean, no typos. Very good job all the way throughout. I can't remember some of the others that might be as strong. Well, I'm always scared. Try it. Adobe. Yeah, I'm always scared to do the Microsoft one. He put a type, he made it there. Yeah, his issue is he's so detail focused that he had a tough time really summarizing here. So it's a little too much wordy here on this first part. But at the same time, this is Microsoft. So it's really hard to get Microsoft on one page because they do so much. So it's almost impossible. Coca-Cola is a lot easier. There's not as much stuff. So he struggled a little bit on that. So it's probably too much, but he probably couldn't have gotten in much shorter than that. I don't remember Adobe, which, let's see. Adobe was written by Ryan, I think. I just saw Ryan the other day. Yeah, that's a good looking crisp. I like the color. As long as this section is separate from that section, this paragraph's way too long, right? Definitely don't want that. That's just really hard to read, but this is nice. Now he has a bullish position and bearish position. I don't know if I would do that either. Go with one or the other. So I have bullish position and risk to outlook. That would make more sense. Don't say, hey, I would buy it in this case, and I would sell it in this case. That's not why your boss hired you. What does your boss want? Tell him what to do, right? I got to manage portfolio. You're doing our research. Don't come in here and say, hey, you might buy it, you might sell it. Let me know if you need anything else. Like, yeah, I need to know whether I need to buy it or sell it. But there's some good stuff in there. It looks good other than that really, really long paragraph. Was he?
Trading at 670.
Oh, really? Yeah, I think he actually emailed me and said, hey, wow, it's pretty close. He put some extra information up there. I do like the year to date, or I actually trailing 12 months performance. We're in November, December, so year to date could work. And he put some data in here. Yeah, I mean, it can work. Other than that, just being way too busy, too lengthy. He did keep it to one page somehow, but boy, really, really tough. All right, so write it first and then set aside a few hours just for formatting. This is a paper where you got to set aside for formatting. I'm hoping you've been doing that. I can't have somebody encourage you early in the semester. Think a lot about formatting when you start. So you don't have to make a major change, because if you make major change, you can mess up all your charts somewhere else. So you want to somewhat think about it. Here's one where this has got to be a different format than everything else. If you want to turn this in as a separate paper, just for that reason, I'm not good enough for Word to do that format and switch to this format. I know you have to kind of put a break into the paper. But you can tell you put some time into really making it look like a sell side paper. So that's a big part of it. I'm going to read it and see what you say. So that's a big part of the grade, but also I'm just going to step back and look at it and say, if I were just looking at this and not knowing it's a student paper, what I think this could be an actual credits release report that they would publish. All right. So do put some time into that. It's the shortest paper, but it doesn't mean you're not going to spend some time into what you're going to put in there. And then you got to put some time in the formatting. All right. It is an interesting industry. As I said, it's extremely autonomous. That's why this class is so good for this, because what you did in this class is really and truly what you do in practice. The only difference is I gave you a whole lot more guidance than they're going to give you. So you're somewhat on your own. You got to figure it out on your own. I gave you more guidance. I mean, they gave me zero guidance. I got the job and they said, Ron, start analyzing. It's like, okay, what should I do? We didn't have Bloomberg that I could use on my desk. And so what I did, I went to my college classes. Okay, dividend discount model, I can do that. I need a growth rate. Where's my professor that's going to give me that growth rate? Where's the professor that's going to give me my beta? Oh, I'll go look beta up on Yahoo Finance. There it is. There's my beta. I mean, not much guidance at all. So some jobs are like that. Some are not. Some have very, very strict training programs. But I know talking to Ryan, boy, they just threw him in there and he just started doing it. And obviously, you talk to his boss, but the boss is expecting you to come with really major questions. So, it's not like college students I have as professor, tell me what I do next. Tell me what I do next. You don't do that in practice. If you don't know how to do it and your boss is talking like you should know how to do it, then you don't ask any more questions. Maybe you have a teammate that will tell me how to do it. If you don't mind looking stupid to your teammate. My first finance job, Lisa was already there, and she was really, really good. She showed me everything I was supposed to do. So I was really, really lucky. We're still really good friends today. We had a horrible boss, so we kind of bonded over having a horrible boss. But she made it much easier. And neither one of us were jockeying to take our boss's job. We were kind of hoping to get out of the department. So we worked really well together, but you might not have that. And in fact, on the sell side, you got people that are hoping that you fall on your face. So you may not want to take their advice on what to do, because it might be leading you down the wrong path. So it's tough. If you're like I was and completely insecure when you graduated, then start on the corporate side, learn the industry. As you get your footing down, then you can jump over to the investment side. It's a lot easier that way. If you're like Ryan, like, hey, I'm going to be CEO of JP Morgan in a few years, then, go for it and just be, he got it done by just pestering his boss over and over again until his boss finally said, okay, shut up, I'll do it. So All right, so that's it. You've been an analyst for 3 months. And you'll see how it all comes out. Any questions? This is our last class. I am your professor for life, so you can call me anytime. I won't give you investment advice. But I remember once I had a problem that I couldn't solve, and I called Dr. Miser, and he walked me through a really good process to think about it. So I'm willing to do that anytime. I don't know a lot of your industry. Y'all are going to be well advanced to me because you can get so specialized that I won't be able to help you much. But you're welcome anytime to call any of your. You should be able to call any professors, but you want to call me with questions or those kind of things. If you do great in this class and you need a reference, then yeah, use me as a reference. I had a student that failed my class, asked for a reference not too long ago. It's like, that's a little tough for me, but if you're doing well, I can certainly be a reference. So I want y'all to succeed. So good luck, and let me know how it goes. Any of y'all working in security analysts next May? It's out there yet. So, all right, well, let me know if you get out there. All right, thanks, guys.